Alright, so welcome back to another episode. Today we're going to be talking about understanding cash flow, especially within a business, and understanding the difference between cash flow and profit. I think a lot of people get that mixed up, so we're just going into detail on some normal challenges, things to deal with cash flow, ways to forecast it, and just to get the business running profitable and getting that positive cash flow going.
Yeah, so I think it's a really important topic that people not necessarily understand. A lot of the questions we get from new business owners and even existing ones is, I've made all this profit, but where's the cash? Mm-hmm. And I think in its simplest terms, cash flow is just how the cash flows through the business. A very simple example: you sell $10,000 of goods to a customer. It's on credit, so they pay in 30 days, 60 days, whatever it is. Let's just say for this example, you've got no expenses, so your profit's $10,000. But at the end of the day, you've got no cash because they haven't actually paid you. Mm-hmm. And you can see how that extrapolated over the year can lead to a very big difference in profit versus cash flow. So, and it gets more and more complicated as they have debtors, they have creditors, they have finance, they self-fund, all different types of things happen. So the cash flow is a really pivotal thing to understand and will help drive the business forward. So there's a lot you can do in terms of managing it, but also looking at it and getting reporting on it so that you're aware of where it is.
Yeah. It's some things that people sometimes don't understand very well, but it's important to understand. For example, paying down the lease of an asset. That's not technically it's a cash outflow.
Yep.
So you're out for cash, but it's not an expense that you can deduct against your profit. So, if you, again, sell $10,000 worth of goods, you have an asset that you're paying off, and you've spent $5,000 paying off that asset, you've actually still made $10,000 profit, even though you're out $5,000 worth of cash. So those things are important to understand, help factor in how you manage your cash, because managing your cash is very important, because that's how you can run a profitable business. And not if you have enough cash to pay your suppliers or pay your wages. It's very important, and it's important to understand how that works, especially because cash flow is different to a profit and loss, for example.
Yeah. So common cash flow challenges, depending on what industry you're in, you'll see different issues or different challenges that you face with cash flow. So, construction's one that we deal with a lot of clients in, and the big one for them is obviously rain. So if it's wet and they can't actually do anything, they've still got costs that they've got, but they're probably not generating any income. Maybe for some of them it's great because they can have an admin day and they might actually get some invoices out the door. So sometimes it can actually be beneficial for them, but generally it's not very beneficial for them. Some other seasonal fluctuations can include, winter.
For clothing brands, for example, or swimwear even. It's important to manage your cash flow. If you're selling less stock over winter, you don't want to buy so much inventory and stock for those periods, because you might be out a certain amount of cash, but not enough cash is coming in to cover that. So it's important to understand the seasonal fluctuations, but also to understand when to spend the cash and when also to hold back. You might have had a really good season, and then you think, all right, this is great, let's ramp up. You buy a bunch of inventory, and then the sales slow down, and now you have all this stock that's you're holding that you can't actually sell. You're paying rent for that storage. It's kind of a lost cost of actually holding that stock. So important to understand also your inventory as well as your cash flow, depending on what industry you're in again. But it's important to not overspend when you don't need to, or you shouldn't. And also to understand overstocking, things like that. And again, with construction, you're losing out on that time as well. If a job was meant to take you a month, you're meant to get invoiced, or you're meant to get paid at the end of the month for the work you're meant to do, but you've only done, 3/4 of a month's work, you might not get paid. So that'll slow down when your cash is coming in. And that stuff is also important to understand. So it's also good to have a cash buffer to cover for that as well. We've spoken about having a cash buffer quite a lot of times, but it's very important to have a bit of an emergency fund in case for those seasonalities or those things that you don't expect to happens.
Yeah, that's right. And I think if you can understand your cash flow cycle, and what I mean by that is, how long it takes for your debtors to pay or your customers to pay, how long you can withhold payment before making payment to your suppliers, and then how quickly you turn around your inventory if you're a product business, or your WIP if you're not a product business. If you can understand that, you can then kind of structure the business in a way that you minimize those cash flow issues. So, for example, let's say we're a service business, we've just got WIP because people are just putting time on the timesheet or whatever they're doing. We bill monthly, so we might do a heap of work in the month, bill it, and then by the time we bill it and then get paid, it's been 60 days. We might have an overdraft that is the same amount as our average rolling debtors. In that way, we're not out of pocket and we're not having to fund the business ourselves, knowing that if we were to wind up the business, well then by the time we collect all our debtors, it pays down our overdraft and we're left with nothing. So that can be a strategy where you get an overdraft to fund your cash deficit, for example, during that time. But I think understanding those important parts of it can really help drive efficiencies.
Yeah. And with WIP, if you're not aware, WIP is just work in progress. So pretty much work that you've done but haven't been paid for technically. So pretty common in professional services, but also in construction services as well. So usually at the end of the financial year, if you're doing a few jobs at 30th of June, you haven't invoiced for them yet, and you haven't received the cash, you kind of take up the difference as well. So that's sort of what work in progress is, or WIP, as most people in the industry call it. But again, important to understand that. And again, with the cash flow cycle, that's also really good. If you have a system set up where you pay your suppliers or your creditors after 30 days, for example, and you also collect your receivables and your sales on 30 days, you have a good cash flow cycle where when the money comes in, you can also pay off your accounts payable or your cost of goods sold and your suppliers. So having a good cash flow cycle and something that's easy to forecast makes it quite easy to manage that cash flow. If you know if you have set terms with your suppliers, at end of the month you pay all your suppliers, for example, from that month, then you know that at the end of every month you need cash to be able to pay them. If you have a good terms with your clients that they pay you at the end of the month or they pay you at the end of 60 days, it's easier for you to understand, you're going to have enough cash because you got cash coming in on that day, and then you can pay your suppliers. But also things like that sometimes don't go to plan. Clients don't pay you, and sometimes it can be a bit frustrating. But again, having a good cash flow cycle is important to be able to keep it profitable, be able to pay your creditors and keep the business going. And that can be done with good pricing strategies as well. If you set up with clients that they're on a retainer basis or they pay you monthly, that cash is coming in because every month they pay that much. It might not be the total amount that's split up, but at least it's easier to plan for cash flow because you're getting paid monthly by that person. You might have some clients that pay you monthly, some that just do lump sums, different strategies, but you got to make sure you understand that you need to be able to cover your accounts payable with your accounts receivable.
Yeah, that's right. And we normally, talk about cash flow in terms of cash flow days. So, like you said, how many days it takes to collect, how many days it takes to pay. And so working out what those are, so you're clear on it, and then working a strategy around that. But, when we meet with clients, we might say, you want to take as long as possible to pay your suppliers. Not always practical. So we understand that. But, if you can work out what is it that I can get away with, well, then you can kind of lock in, okay, well, that's my cash outflow days. I need to try and ramp up my cash inflow days so that there's a difference there where I'm cash flow positive if possible. So, and same for inventory and WIP, just making sure you're turning those over in a good time.
Now, discussing terms with clients. So what this really is, most commonly when you send out invoices, a lot of the time you'll see, if you've received an invoice, you'll see terms net end of month, for example. So your terms are that you'd like the client to pay you at the end of the month or the end of the next month. being able to discuss those terms with your clients and have a strict deadline makes it easier to forecast your cash flow and help you manage your cash flow. Because if you know that, you know, you're sending out this invoice, that client's going to pay you at the end of the month, you know, you've got that cash coming in, that can help pay wages, help pay expenses, pay your suppliers. It's important to discuss those terms. It's not good just to send out an invoice and just hope it gets paid straight away. You also don't want to have too restrictive terms where people don't want to work with you.
Yep.
You know, it's not like pay within 2 days of receiving the invoice. Sometimes some clients don't want that. So it's good to understand and get a good level and a sort of meet in the middle a bit. You want it to be good for you, but also good for them because they're managing their cash flow and they want to have good terms with their suppliers and things like that as well. But there's also ways to improve this, like offering incentives. You know, if you get a discount for paying early, or you can also offer disincentives for paying late. Some people charge you interest if you're certain days over the terms. And there's things like that to make sure that you do get paid on time.
Yeah, perfect. And just to touch on that, you know, there's several ways that you can decide on those payment terms. You know, some people are dictated by the industry they're in, where they may only be able to get, say, 10% up front, then a 30% progress payment or whatever. But, you know, generally people can do monthly, they can invoice on completion, invoice up front, 50% up front, 50% on completion. So there's thousands of ways that you can probably do it, but just be clear on what yours are. Have the conversation up front with the suppliers, clients, whoever it is, and that way you can just get all that out of the way up front. You know, that's how we do it with our clients. We just have the conversation up front. This is the fee, this is how it's going to be billed, and then you can just get on with doing the work or providing the product or whatever it is in that situation. But that's the best way to do it in our opinion.
Yeah.
But the good news is, like, most of that can be done through, you know, software, right? So we've got a program and there's plenty out there that can automate a lot of that. They help with sending out the proposals for signing, help with collecting the payments, reminders, all that sort of thing. So I think it is come up with your terms, discuss and agree on them, and then just put it into the system and let the system do its job. Obviously monitoring and making sure that it is doing its job properly and coming back to a review. But I think if you do all that, then, you know, that'll help your business in terms of, you know, managing your clients and the cash flow from them. Yeah.
And it can be different again for each industry. If you own a business, for example, that sells goods, obviously they pay you right there. But then there's also methods like Afterpay where, you know, that technically paying there, but they're actually paying in installments. You get the cash up front. So it's not always the same with every industry, and it can be different in each one. And also if you're dealing with bigger clients, they're the ones that have the more bargaining power. So they kind of set the terms. If they say they want to pay you on the 60 days and they're, you know, a big client of yours, it's kind of hard to say, no, I want to get paid now, you know?
Yeah.
And then that's when you need to sort of focus on, you know, they're going to pay me, but I don't have the cash now. How can that work? You know, if you're trying to grow your business and you've just landed a big deal and you don't have the cash, it can be difficult. I know you've had clients who've had similar situations.
Yeah, it's a good point, right? So, like, you've got the situation where you've got the future work already scoped and probably agreed to, but you don't have all the necessary components of it. So whether it's the inventory or whatever it is. So how do you fund that gap, right? And it's not always the case that the owner can fund it. They might not be able to. So I think if you work with your advisor and hopefully within their network, like, you know, we work with our finance team. So James from Sydney, who's fantastic. And he's able to get finance for clients that then helps them get to that stage so that they can grow the business to the next level, which wouldn't typically be available if they hadn't come and saw us or spoken with someone. They'd just go, well, I can't get that much inventory. And then therefore they miss out on that contract, which can be quite detrimental to some businesses. So,
And it can help grow the business and just fill that gap in between where you need the cash, but you don't have it. And, you know, if you have the cash, you'll be able to grow the business so much. But, you know, that's important to understand that there are opportunities to be able to get that cash.
Yeah.
But it's just knowing how to.
Yeah, exactly right. And, you know, they may take security over your home or over the business or over just the stock, right? So you might need to just finance the stock, and it might be $1 million in stock that you need to get, and they might just take security over that. So understanding that side of things, but, you know, work with your advisor. They'll work with the finance team as well and get something that works so you can move that business in the right direction.
Yeah. Some other things to consider would be the negotiating terms with suppliers for your cash flow. This can just be, instead of paying when you go to pick up the products, you can create an account with your suppliers. If, for example, you're a builder, you buy things from Bunnings, instead of paying for them right there, you can put them onto your account. I think you need to have by a certain amount with these suppliers to be able to create an account with them, but then they have set terms that those products need to be paid by. So instead of paying them right there and then, you kind of get a chance to plan ahead. So if the terms are that you pay 30 days end of month, you buy the products now, you don't have to pay for those products until 30 days after the end of the month. So you've got a bit of time to plan ahead, being able to get that cash ready to pay for them, and at least there. That just makes it easier to plan for the cash flow. And you can do that with many suppliers, many clients. The bigger the supplier, usually they're the ones with all the bargaining power, similar to clients. Because if they say that they want to be paid, within 2 weeks' time, and you're a small business, they're not losing out that much by not having you as a client, but you might be losing out not having them as a supplier. So sometimes you have to adhere to their rules and make sure you pay with their terms, and that's when it can be a bit difficult, especially when you're a small business trying to grow. It's important to understand that, and setting those terms and understanding those terms will help plan with cash flow as well. You can also get discounts for bulk orders as well. So especially for product-based businesses that are buying inventory, you might see it sometimes with your supplier where if you're a clothing business, if you buy, for example, 10,000 garments instead of 1,000 garments, you'll get a much bigger discount. Obviously then you're paying more and you're going to have, more inventory, but you can still get discounts by doing that. In the accounting world, it's called economies of scale, but all it is, the more you buy, you can get for each unit, at a lower price. So that's just some things you can do. I know you had some other things like the stock on consignment.
Yeah. So, you can come up with an agreement with the supplier where you might take the stock on consignment. So rather than paying for it up front, you pay for it once you've sold it, for example. But to touch on your previous point, those bigger ones where they control when they pay you, annoying from a cash flow perspective, but generally that they're going to pay, right? Because it's like, okay, 60 days, but the cash always comes in. So that's where that overdraft strategy can work really well, because that they're going to pay, and you're just dipping into that overdraft in that period where there's that gap basically in cash. So having those sorts of clients isn't always bad, but it's great if you have the smaller ones to fill the gap in that 60 days as well. We touched on extending payment, but obviously, if you pay on time regularly to start, that can build credibility, and then over time they might go, as long as you pay us within 90 days, we're all good. So I think that's an important one, is just, try and get trust from them early on, build that relationship, and then see what their options are in terms of, extending the payment terms.
Yeah. So in the ideal scenario, your clients pay you straight away, and with your suppliers, you pay them a bit slower. Obviously, it's not always like that, but the closer it is to that, the better. Obviously, you don't want to damage your relationship with your suppliers, but if you have a good relationship with them, like you said, they're happy to extend those days, then it gives you a bit more breathing room there. So if your clients pay you earlier, but you pay your suppliers later, it helps fill in that gap or that cycle, and it's beneficial for the business, but obviously you're still going to have to pay them at some point. But the longer you extend it, the more beneficial it is.
It's catch-22, isn't it? It's one of those things, pay me straight away, but I'll pay you in 60 days just because I want the better cash flow. No, that's cool. So when it comes to forecasting cash flow, I think there's plenty of tools, plenty of templates out there. Anything that you could provide that would put someone on the right track if they're just getting started from a small business perspective?
So I'd say a good thing to do is have up-to-date data from there with your accounting file, with your Xero or your MyOb. As long as you have up-to-date data, then you are able to forecast it. I know we've used tools like Fathom, and now there's Sift as well, which looks pretty good too. It helps look at past performance or past cash flow to be able to determine future cash flow. So what I mean by that is it can see when you've been paid and when you've been paying suppliers, and help forecast it that way. So if the accounting file shows that you pay your suppliers at the end of the month, but your clients don't pay you until 60 days, then it gets forecasted into the cash flow and you can see when it's coming out.
Yeah.
Some ways to help plan for this and also make it a bit better for you is, to pick up clients that have a retainer payment, for example, as in you do work for them, they pay you monthly. That money is always going to be coming in monthly. It helps you with cash flow. And it's the same the other way around for, expenses. If you have like a big one-off expense, like insurance or advertising, see if you can switch that to a monthly expense. It just makes it a bit easier and it won't catch you off guard. If, it gets to June, you forgot that in July you've got a big $20,000 insurance expense and now you don't have it, or you do have enough cash, but it's going to put you in a bad position. It might, mess things up cash flow wise. If you had split that $20,000 up, monthly, you'd be kind of already factored into your cash flow. So things like that make it much easier. Of course, just check if there's any fees. I know you're saying some insurance companies now, they're not charging fees for switching to a monthly basis, which is great, especially for cash flow wise.
Yep.
That way it's so much easier to plan because every month you're going to have $2,000 that you need to pay for insurance, for example. And it just makes it easy to cash flow and you won't get caught out with a big expense just randomly off the 1 month,
Yeah, that's exactly right. And I think if you're just starting out and you don't have any previous data to go off, then just keep it simple, right? Like forecast your sales, forecast your expenses, and then just to assist with doing, so basically just do a pro forma P&L, profit and loss, and then work out where the cash goes, right? So if you do your sales and you're a services business, you're going to be billing off probably every month or more, then just factor in the timing of the cash payments. But, just start simple and build it up from there. See someone if you need help and then use the tools that can also help with that. But the forecasting tools are great. If you've already got historical data, then it will get you 90% of the way, and then you just do the 10% of, okay, well, this year we've actually got this contract, we're going to put on someone else, got a factory, whatever it is, and it will then adjust the forecast as necessary. So the tools are great.
Yeah. And I think a good period to do it by is monthly. I find, especially, if you pay your suppliers monthly, your clients pay you monthly or on a monthly basis. I think monthly is just enough information. Weekly would just be a bit too much for cash flow wise, especially if you're trying to forecast ahead for the next 12 months. It's much easier to do it for the next 12 periods instead of the next 52. You have to do 52 weeks, but 12 months is a good way to do it. But like you said, it's good to get your profit and loss ready, but it's also important to understand some cash outflows aren't part of a profit and loss. So this is when an accountant would be great to be able to explain to you where your cash is going, and it might be different to what your profit and loss shows on your zero file, for example.
Yeah.
So, there's ways where you can be cash flow negative, but still be profitable. If you're on a profit and loss, you're making a profit, but you have all these assets that you're paying off, and your cash balance is slowly decreasing month on month, then it's just because of those lease payments or those assets that you're paying off, even though on paper your profit and loss looks good. And it can be the other way around. You can be cash flow positive if you're constantly putting money into the business. Yeah, your cash balance is growing, but on paper the business is running at a loss. So important to understand those parts, and that's when an accountant can come into play to explain the differences and help you forecast and show you where the cash is going. And it's always good to, have a conservative approach, also have, best case scenario, worst case scenario, and be able to understand that. And having a monthly forecast will show any seasonality as well. So, if you're a business that's, quite seasonal, like a swimwear brand, it's easy to understand that, June, July, August, probably going to sell less swimwear. Let's not buy as much inventory. Let's focus on maybe creating a winter outfit. I don't know. Winter clothing.
That's right. Those winter swimwear. No, but it's a great point, right? Like you should really focus, if you just want to like niche into swimwear, well then maybe in those months you focus on, okay, well how do we then get to the rest of the world? How do we get to the international markets so that we can service all year round, right? So, like particularly a small business, right, in Australia, if you have a swimwear brand, you know, your busier months are going to be the summer or spring. So then how do we mitigate those downsides? Well, okay, we can either expand internationally or go into another product. And they might go, no, we just want to niche down in swimwear. Okay, well then let's focus in those winter months how we get into those other markets. Or focus on the next season's swimwear, of course. I mean, I'm no expert in the industry, but that's where I would start, right? That's how I would then push forward. So, great points. So, I guess in terms of, you know, quick wins to improve cash flow, like the one that comes to mind a lot is a vehicle. And the question that always gets asked, should I finance or should I buy it outright? And I think it's so dependent on what's going on at the time, right? Like, you know, typical vehicles are between 30 to 100, let's say, depending on what they're getting. But like, that's a lot of cash to put out of the business if you're in a growth stage, right? So generally you would suggest leasing the vehicle so that at least the payments are staggered. And another thing to consider now is the instant asset write-off that used to be basically uncapped. Is now very much capped. So by financing, you're somewhat allocating the depreciation over the repayments so that there's not a huge mismatch in terms of the cash flow. Whereas before, you'd get all the deduction up front and the cash flow would go out over years. So I think you've really got to work with the accountant and figure out what's going to work best for your business, what cycle of the business you're in or stage, sorry. And that can really make a big difference. So
just to touch on with the instant asset write-off. So during COVID, if you bought an asset even over $100,000, if it was deductible fully, you'd be able to depreciate it all. So let's say you paid $100,000 for a vehicle, you out of cash $100,000. That wouldn't usually be the full $100,000 deduction, but during the COVID years and a few years after that, there was a thing called instant asset write-off where you could instantly depreciate that vehicle in that year. So you paid $100,000, you got a $100,000 deduction. Now it's not like that because the instant asset write-off is capped, like Andy mentioned. So you can buy a $100,000 vehicle, be out $100,000 in cash, but you only get the depreciation amount, which is 25%, I believe, for a vehicle. So you only get the 25% deduction in that financial year, 25% the year after for the amount of time you hold it. And that's why, like Andy mentioned, if you got it as a financed, those payments that you make usually would be quite similar to depreciation you can claim. So then it's sort of like the amount you're paying yearly, the cash that's coming out, you're actually getting that deduction instead of paying a massive amount up front where you're out of cash up front and only getting a portion of that back. So that's important to understand. Things like this come up every year where the ATO creates incentives for businesses to keep growing. That's why they created that, for businesses to keep buying assets, because they were able to claim the deduction. And every year things change, things come up. You know, if you're a certain industry like farms, you can have different benefits and different grants. So again, it's good to talk with your accountant to know what's out there and how to best manage that. Because, you know, you might have $200,000 in cash, but is it worth being out $100,000 that year out of cash, or is it worth financing it and getting that deduction year on year through depreciation? So different for every business and whatever stage you're in. But yeah, definitely important to understand that and, you know, optimize your cash flow that way.
Yep, and I think another one that's made a big difference in a lot of clients is we've had a few clients over the last year or so that they've got really good businesses, but they have not really paid much attention to their debtors. So their cash flow isn't great because it's all just sitting in debtors. And then as soon as you give them some simple tips to follow up and chase their debtors or implement some technology to do that for them automatically, the next time you meet with them, the position's completely different, right? They're so much happier. Cash is coming in. So I think focusing on that is really helpful. And then also shortening the sales cycle. So What we mean by that is just basically reducing the time it takes to sell the product or get the cash in the door after you've made the sale. So, a lot of people will just send out the invoice like you touched on earlier, and then just it's out there in hope land waiting for it to be paid. So if you come up with a system that is, okay, send it out, 3 days later, follow up, 7 days later, another follow up, 2 weeks later, get on the phone or whatever, you'll find your cash will come in a lot quicker. And it's not always because people don't want to pay. Sometimes people are busy and they just forget. So you've just got to be proactive.
So just to quickly summarize what we discussed, just, negotiating terms with suppliers, negotiating terms with clients, being able to understand how cash flow works, trying to focus on forecasting that as well, planning ahead, because that's the easiest way to manage your cash flow. But that's quite it really for cash flow. It can be simple if you break it down into simple steps, but again, can be complex if you go into more detail. So if there's any other questions that you might have, make sure to let us know or reach out. We can go into it a bit more detail next time, but really that's about it for cash flow.
Yeah, well said.
Awesome. Well, thanks everyone for listening, and we'll see you in the next episode.